ESG has had quite tumultuous time over the past 18 months to 2 years with the geopolitical context, whether it's the energy prices skyrocketing, the cost of living crisis, inflation, the US-China decoupling risk. So with that, I'd like to first start with a question to Ulrik. And well, do you think in this geopolitical context, have you seen whether ESG has become secondary given the other crises the world is facing?
Yeah, well, first, thanks for having me today. I think that's probably been the case a little bit as we went into the European energy crisis, and where priorities somewhat changed and had to change from decarbonization efforts to energy security, and with Europe having closed down a bunch of nuclear, with a great dependence of gas from Russia, I think the need to continue to be able to power homes and supply energy in a secure and safe way, while we had to turn up the pipes, unfortunately, for both gas and coal. So I think that has been the case somewhat, but ESG never goes out of fashion. I think those concerns are still there, even if there was an increased use of coal and gas. But I think there is something to be said about that, yeah.
Thank you. And Timothée, can I ask you whether the context has had, what kind of implication it had on your business strategy and your ESG strategy internally?
Well, when the crisis started, we had a thorough discussion with our CEO and our management, and I mean, she asked us the same question. Well, the case we made at the time was that we're here in the long run. So you have to think about what's going to happen right now, tomorrow, in the short term, but also what's going to happen in the medium term and in the long term. And if anything, everything you described, we believed at the time, was actually supportive of sustainability objectives at EU level and at global level in the long run. So if you want, the strategic positioning and thinking was there, and we kept it. And I think that with insight, it's really fair to say that with this alignment between energy security and energy transition objectives, if anything, it has accelerated EU journey and perhaps the journey that we see on global markets. So that's one, but we also went through a tumultuous phase on the regulatory front. So that's something we had to deal with. And I guess that called for clarification. Number one, how do you position ESG within your value proposition? And second, also, what level of transparency you provide vis-a-vis your investors, prospective clients. And here the motto really was, say what you do what you say. And then we felt we were in a kind of like safe space, really well positioned to benefit from long-term strategic moves.
So to summarize, I think your points, which I think many of us may agree with, is that despite the conflict, and even if we add to this the US political backlash, which have weighed on performance of ESG, which have weighed on flows, they were down 60% in 2022. At the same time, decarbonization has accelerated, and probably progress happened over the past year, 18 months, that we thought were going to happen over a decade, possibly. So we are in a momentum where, based on some of our analysis and market sentiment analysis, we're seeing a very strong rebound. And it's possibly because, despite the crisis, multiple crises, it may have actually reinforced the value proposition of ESG. Yeah. But it has also invited much more scrutiny and regulation. And with regulation on the rise, I guess I'll take a few minutes. I'm sure everybody knows what SFDR is, but just in case, I need to take 30 seconds to say what it is. So SFDR is obviously in Europe, one of the regulations, part of the EU Commission, that is setting the framework to how asset managers should classify their products. And there are three kind of categories at the moment. Article 6, where ESG is not really core. Article 8 is where an investor will take into account ESG, but also non-ESG traits. So fundamental characteristics with an ESG part of their investment process. And then Article 9 being obviously the dark green, but it's not just about climate, where ESG is a core objective of a fund investment strategy. So with that, I'd like to turn to Ulrik, who runs a leading Article 9 fund, a multi-billion Article 9 fund, which is very successful. So could you maybe tell us what does it mean to you, especially with the recent change in revision of this regulation?
Yeah, absolutely. So when we started the Environmental Strategies Group at BNP Paribas Asset Management, it was to do something that we felt really wasn't out there, and that was to create a fund that was focused on solutions, environmental solutions. And the first way to do that was actually to start with, one, not having a benchmark. Think as we start with an MSCI World, MSCI ACWI, you immediately create a constraint on your investment strategy, in the sense that you're trying to mimic what's going on in global markets. And what does global markets represent? Tech, retail, oil and gas, metals and mining, all sorts of stuff. So what we started doing was a fund that was exclusively investing in enabling technologies. And I think we can come in on what we mean by enabling a little bit later. But that meaning solar, wind, batteries, electric vehicles, smart grids, all of the stuff that the world really needs to decarbonize. And hence, in spirit, the fund was started as an Article 9 fund, although there was no concept of Article 9 at that point in time. And hence, in fact, it's meant very little to us, in regards to how we think about the investment strategy, our objective of the fund, with a very strong sense of both intentionality of trying to avoid emissions across the board as a portfolio, having a material amount of impact in regards to environmental solutions and investing where help is needed. And lastly, being able to monitor that and show the world exactly what the fund does. I think it's been great for the investment community. I think it has created a lot of thought around funds that were previously environmental, but maybe couldn't live up to the requirements that Article 9 has, which is a sustainable objective or carbon emissions objective. And hence, I actually think it's been quite helpful.
Thank you. And Timothée, can I ask you maybe at Amundi, how are you aligning your portfolios and your suite of products to net zero?
So perhaps as a segue to your point on Article 6, 8, and 9 and how we position the product, what is critical in terms of Article 9 is to have a sustainable investment objective. So that's the sort of really key characteristics of such product. But then what the regulators added was specific criteria on a line-by-line approach to ensure that each and every investment would contribute to the environmental objectives or social objectives, and they would not be associated with significant harm to other sustainable objectives. So that's what was the evolution in the regulation that we had to deal with over the past 2 years. And so on our side, we felt that created a bit of uncertainty, to the extent that the regulation was not very prescriptive in terms of what do they mean, do not invest into companies that are associated with negative externalities. So we decided to reposition many products into Article 8, but the investment objectives remain the same. And so I think like among industry players adopted different strategies, and gradually we'll see some convergence, but perhaps that was a miss on the regulator's part. And a key also point that we discussed extensively with the regulators was how we could position net zero product. And thinking about net zero product in the light of the regulatory categories that you mentioned, it's about having a sustainable investment objective to actually meaningfully contribute to net zero objectives and related objectives, notably like nature, biodiversity, and the rest. So that's one. But it's also investing into the economy to support companies, industries, and players that are gradually transitioning to business models that are compatible with 1.5 degrees, even though we know that's a far-fetched objective. So we think about net zero through this double lens, if you want. There is a set of category and products that are really meant to be concentrated and to make high conviction bets into project companies that are enabling the world to transition, but we also want to develop, and we are developing a suite of products that are meant to invest into the broad economy, across sector, across regions, and we make sure that they keep their exposure to high climate impact sector, because these are the sectors that we need to transition in a very fast way. And within these sectors, we favor the companies that are most advanced or that are catching up. And so that's how we think about net zero. But then, of course, that's in line with what the EU regulation expects, but that's in line with what our client expects. We have binding characteristics which are described in the investment policy or objectives of the fund. That's what SFDR brought. Some players were doing it, now all players have to do it. If you promote characteristics, they need to be binding, they need to be described in the pre-contractual documentation.
Absolutely. And I'd like to come back to a point you just mentioned, which is the initial, or where people are, or where most market, or what happened recently is that Article 8 has become, unfortunately, given the regulation and the uncertainty around the regulation, a sort of catch-all. You will have in that category very much leading funds that embed ESG across the entire investment process from the A to Z, with deep analysis, even in the trading strategy. Yet you will also have funds that don't look at ESG at all, may have a score at the end of the process, a check mark, and that's it. Yet they are presented as Article 8. Both can be justified under the current regulation. So this is becoming an issue because now it's out of 11 trillion AUM that are SFDR labeled 6, 8, or 9, over 50% now are Article 8. You have 6 trillion. Article 9 are 400 billion, yet, and Article 6 is the rest. So basically, Article 8, the regulator may need to look into how to help investors, clients navigate that space. So can I ask maybe both of you, or each of you, for maybe what would be, because there has been some frustration with the regulator, although the ambition is welcome and they are tackling the uncertainty very well. Recently, they added climate funds being eligible to, re-eligible to classify as Article 9. But what would be your 1 or 2 recommendation to the regulator, if you could just ask?
I think a little bit like ESG has been weaponized, and I think we've learned that we, in a way, need to move a little bit beyond ESG, that ESG is not necessarily a sign of goodness or badness, and it's certainly not a noun. You know, it frustrates me when people are talking about an ESG fund. We conduct discounted cash flow analysis till we're blue in the face, and we don't call ourselves a DCF fund. And hence, ESG is it's a process. It's not a thing. And I think it's a little bit like net zero. So I think, you know, if a retail investor goes in and buys a net zero fund, they think, well, probably buying something that's doing good. And there, I think what we're missing a little bit is a differentiation between who's an enabler and who's an adopter. And maybe I should explain that. If you're producing tennis rackets, and you're doing so, producing a little bit less carbon every single year, you can have a business that's net zero aligned. Does the world need more tennis rackets? I'm not sure. I'm a big fan of tennis, but I'm not sure. But still, that goes under the label of being net zero. Now, the world needs more solutions. We need more solar. We need more wind. We need more batteries, etc. And it's very little institutional participation we see in those types of companies because they're quite volatile. They move. Guess what? Innovation moves. And we need money and investors and capital asset managers to take some risk and provide that support for companies. So I would, my plea, I think, would be, to get to the point, have a greater differentiation within portfolios, a very simple measure. How much of your portfolio is adopting, as in producing tennis rackets with a little bit less carbon every year, and how much of your portfolio is actually enabling, providing a solution to the tennis racket company that needs to decarbonize. And I think you'd get a really interesting picture out of that.
Thank you.
Well, I mean, I would second what you said, and actually the net zero solution I was alluding to, be it passive or active, actually we kept that as Article 8 because they are meant to invest into the broad economy. And we felt that the natural positioning of Article 9 was about investing solely into the companies that are actually making a meaningful difference. But actually what you were describing is coming from the fact that at the Commission level and European Supervisory Authority level, they haven't really made up their mind whether it was a transparency regime or a labeling regime. And so our one big ask is choose. And then we're going to adapt. And the entire industry is going to adapt. But we cannot be in the middle and having some provisions that are leaning towards one side and other that are leaning towards the other side. So that's one ask. Second, adapt the level of transparency requirements to the target asset classes and the realities of the investment universes that we deal with. Taking one example, the sustainable investment concept, which is at the core of an Article 9, it requires to do a full-fledged DNSH test. That requires having access to robust and reliable data. Can we use that investing into frontier markets, into less developed middle income economies? Well, maybe we could. But that's a regulatory risk. And you need really not to lose sight about what are the initial objectives of the regulation. First objective, making the markets more transparent, increasing the level of integrity. That was one. But there was a second objective, which is about really mobilizing capital market to support the financing of sustainable development objectives and climate objectives. They were doing so in a way that is compatible with the duties of an asset manager because they had the premises that EU savers, they had huge appetite for sustainable product. We think that's true. We just need to make it work. But it's really about rethinking the provisions of the law with the benefits of experience to ensure that you serve the initial objectives of the regulation.
Thank you. And I guess maybe one other question then for you on the regulatory side. At the moment, and please do comment if you have one, but at the moment the regulators are mostly focused on disincentivizing the market from investing in fossil fuel or coal or taxing plastic, etc., which is obviously very good. But at some point, and maybe coming back to a point you were making in terms of that differentiation, is also perhaps how can we incentivize and have a more of a, the IRA is a very good example, but that's one example, but having a suite of regulations that are more about incentivizing the market, whether it's investors or companies. Any comments or thoughts about that?
Well, I'm sure you're going to have a lot more smarter things to say on this than I can, but just to give you my 2 cents. Number one, there are still a lot of incentives that are going to the fossil fuel industry.
So correcting those, for example.
And just like correcting that, and we understand there is a question of purchasing power in many economies, and it's something that you need to factor in. Nevertheless, if we want to be serious about accelerating our climate journey, we need to address that, and it's significant. I mean, it's 700 billion a year, and the amount that we need to invest in like renewable energy in emerging market, that's 1 trillion. I mean, it's not so far. So just like pulling out these numbers, putting it there, it's not that simple, but that could help a lot. Second, you need probably both. And really, if you talk to the experts that are really analyzing what levels do we have to accelerate the transition, they tell you, well, we have little things at our disposal that can make a marginal difference. And so we don't have the luxury to select only few. You need really to have no stones left unturned. And that's hard because it's a big shift for our societies, for our production systems, and it needs to happen very fast. So you need price signal, you need controls, you need to think about the value chain, and you need all of this, we believe, to make it happen fast.
But one big call I take from this is actually we should have data mapping those incentives to the fossil fuels industries, or much better data, because that could be tackled much better. So, Ulrik.
Well, I think just quickly, I think one headline is just pricing externalities, pricing carbon, pricing natural capital footprints as a start, and that's been an incredibly slow process. And this comes back maybe to me trying to answer two questions, one on regulation and one on this, and that is that the fear with regulation and with all the confusion is that we end up using regulation as sort of a little bit as a dummy and go back to sort of the lowest denominator. We can do better and we can do more. And I think what we're trying to do is say, okay, there's a regulatory framework and that's great, and we're Article 9, et cetera. But we need to do more, not just what they tell us to do. We need to do something that actually makes a difference. And this is where the asset management industry, I think, has a huge, huge role to play. It's a matter of public record that we've just been out cornerstoning a big hydrogen company in Europe. I think we need more risk capital like that to go in and take some risk, and say, yeah, we're behind some of these companies that are making solutions, and not just rest on net zero, Paris alignment, Article 9 versus Article 8, et cetera. We can end up getting lost in KPIs and kind of lose the common sense. And the common sense is there's a problem. It needs a solution. In fact, it's very profitable to invest in those solutions. Big growing markets, the IRA, Inflation Reduction Act, European Green Deal. This is a very, very attractive, interesting area to invest in, and probably the mega trend of the next couple of decades. So it's a win-win.
Thank you. Because we have only 1 minute left, I'm going to have to skip a question, but I'll hope you weave it in one of your answers. So in the minute we have left, can I please ask each of you to share with us what are you the most optimistic about, and what would be your vision to happen in the next 3 years, whether for ESG or climate? And hopefully in that answer, you can weave in maybe a bit more comments about what you mentioned before, which I really loved, adopters versus enablers.
Please.
You can take a minute.
All right, I have 15 seconds,
yeah,
and then you have the 5 left. No, I think in 3 years down the road, we will have made a lot more progress understanding how the Earth system works. And that's on very, very high level, but this is where the economic materiality is actually. Climate and CO2 budget is one planet boundaries. Actually, there are others. And we underestimate the impact of climate because we don't understand very well how climate will impact the other planet boundaries. And taken all together, we're talking about 50% of the world GDP. So the impact, it's going to be massive if we don't do what is needed. We understand better the negative feedback loops at play, but we also understand better the positive feedback loops. And I think 3 years down the road, we will see more comprehensive set of policies integrating the issue of climate with the issue of nature, with the other planet boundaries, and impact solution actually really favoring and supporting the solution that take all of this into consideration.
Thank you. Love it.
Well, I would say 15 seconds. Let's move beyond ESG. We can do more. Let's continue to integrate it. Let's use it as a process. Second, net zero is important, but let's invest in what makes sense, common sense. And in terms of themes and areas where we see incredible amount of opportunity over the next 3 years, areas like hydrogen, residential solar, energy storage that will really break up the intermittency that we see in renewables. Very, very optimistic for the next 3 years.
With that, thank you very much, everybody. And thank you to both our speakers. And I'll leave it back to everyone.
Thanks.